Hi, everyone. Thank you for attending. We're just going to give it a few minutes while people get signed in. So just bear with us. All right, well, let's go ahead and start. So good afternoon and welcome to today's webinar, where we will take a look at the impact the coronavirus is having on the housing market as a whole. My name is Jennifer Von Pullman, and I am the Director of Content and PR here at ATTOM Data Solutions. So I'm pleased to introduce today's speakers who will be guiding us through this webinar. Todd Tita, our Chief Product and Technology Officer, and Ohan Antibian, General Manager of RealtyTrack. All right, so here is a little bit of the items that we'll be discussing. So we'll give you a quick introduction about ATTOM Data Solutions, as well as uncover the various data products and solutions that ATTOM offers before diving into what you all came for. We will also we'll take a detailed look at the data behind our special report that was released a few weeks ago on the U.S. housing market, vulnerable to the coronavirus impact, and offer unique insights into why certain regions are more at risk, what this means for those distressed markets, and how this will affect industry business solution providers. Please feel free to submit your questions throughout the presentation through the question box in your menu bar, and we will make sure to respond within 2 business days. So a brief introduction. So ATTOM Data Solutions is your one-stop shop for premium property data and flexible delivery solutions. Our mission is to power real estate transparency and to fuel innovation across various industries with the most comprehensive property data. So if you aren't familiar with ATTOM, we've built a multi-source national data warehouse that blends property tax, deed, mortgage, foreclosure, environmental risk, natural hazard, and neighborhood data for more than 155 million U.S. residential and commercial properties, which covers 99% of U.S. population with more than 29.6 billion rows of transactional level data and more than 7,200 data attributes. We power real estate transparency for innovators in many industries, including real estate, mortgage, insurance, technology, finance, marketing, government, and more. So here you will see kind of a better picture of all the various data products that we offer. This is the ATTOM table of data elements, and it shows how we organize our data into 4 main categories. We have our property and owner. So this is our bread and butter data. We track a lot of information about individual properties, including property characteristics, mortgages, transactions, listing information, and ownership. We have neighborhood data. This category is more about the area surrounding a property rather than the property itself, and it includes demographic, crime, schools. We have boundaries. This is spatially oriented data, including parcel boundary, neighborhood boundary, and area boundaries. And then analytics and derived, and these are data that is derived from our other data sets, and this includes our AVM values, equity values, and more. So now, as you can see, we tailor our solutions to meet the challenges and opportunities in your industry and for your specific objectives. Now, I'd like to introduce Todd Tita, our Chief Product and Technology Officer. Todd?
Thanks, Jen. So last month, a lot of you saw our special report on a county level housing markets across the U.S. We did a study there where we were looking for counties that we thought would be more vulnerable or less vulnerable to the outcomes from the coronavirus pandemic. In prepping that report, we looked at a few key metrics that we generally think of as distress indicators in a market. And I thought it'd be helpful to start with that methodology just so everybody's baselined on how we're going to talk through the data today. First, we looked at foreclosure filings. That's which simply tracks the number of foreclosures that are happening in a particular market. This is really a lagging indicator of distress in that homeowners are already having trouble paying their mortgage. Some of the other factors that we looked at were both short-term and mid-term indicators, or forward indicators, as you might call them. The second one we looked at was underwater mortgages. And that's simply where somebody owes more on their home than it's worth. Their mortgage is more than it's worth. And The third indicator that we looked at is affordability. And that's where we measure the percent of wages that are going towards housing costs, key housing costs like mortgage payments, insurance, property taxes, et cetera, as a percent of their overall average wages in the area. In highly unaffordable areas, demand really decreases quickly when an external event such as COVID-19 happens, and prices decline along with that demand. Ohan's going to speak a little bit about what we're seeing on the demand side in a few minutes. We see affordability as a short-term to mid-term indicator because supply and demand dynamics don't move as fast as job loss, foreclosure, and some of the other factors that you might consider distress indicators. It's clear that without a doubt, these aren't the only factors. These three factors aren't the only factors that impact local real estate markets. You think about things like job loss, infection rates, any other local dynamics, perhaps the types of jobs in the area. And the methodology can get really complicated very quickly. So we set those aside. We set aside some of those really localized dynamics and looked at these three indicators that generally correlate to distress in a market. And that's what we came up with when we looked at a composite ranking at the county level. We did this for nearly 500 counties in the US. So with that kind of framework of the methodology, what did we learn? I guess in short, the results are somewhat staggering when you look at them in detail. The first main takeaway is that there are really regionalized buckets of risk. A lot of the counties that cluster in a particular area tend to look very similar from a metric standpoint. The main reason for that comes back to the fact that we were looking at three key factors: affordability, foreclosures, and underwater loans. Simply put, some parts of the country have seen home prices surge way past what average wage earners can afford, while other areas might see an equity lag if prices have flattened out or declined recently. And that's happened in some parts of the US over the last year. Homeowners who have bought in the past year, definitely at the top end of the market, if you will, are more likely to fall into that group where they're negative equity. Lastly, those elevated levels of foreclosures in some states, including those where banks may be put on pause or delayed foreclosure proceedings or tracking to a delinquency. All of these factors lead to a higher risk in a local or regional housing market. The Northeast in particular, we'll talk about that as a region, really is struggling on all three factors we've been talking about. In fact, 43 of the top 50 counties that we identified at risk in the report are in the Northeast. Contrast that with the West, where only 2 counties are in the top 50. There's a few, obviously, in the top, higher rankings, but in the top 50, just 2 in the West. Continuing with the Northeast, nearly 75% of the counties there are unaffordable, and over 20% of all homeowners are underwater on their mortgage. The foreclosure rates are also higher than national average. So again, it's hitting on all three of those factors. The West is a complicated story, unfortunately. While most of you know that it's one of the most unaffordable, if not the most unaffordable region of the country, there are really very few counties with high numbers of underwater homeowners or high foreclosure rates. So we think that will soften or lessen the impact that COVID could have in the West, and we don't identify that as a high-risk area. Moving on to an area that we were frankly really surprised to see, and it stood out to us, was New Jersey. Nearly the entire state of New Jersey comes up at risk in this report, and we want to take a little bit of a deep dive there. In looking at the top 50 counties, so I'm going to isolate to the top 50 counties, 14 of those were from New Jersey. In fact, two top counties in the report are in New Jersey, Sussex and Warren County being number 1 and number 2. So New Jersey, similar to the larger Northeast region, faces a triple whammy, and I'll dig into those: that unaffordability, underwater homes, and high percentages of foreclosure. In terms of affordability, 14 of the top 50 counties, of the 14 New Jersey counties that were in the top 50, 8 of them had high unaffordability, which we define as homes, housing costs costing more than 35% of wages. Beyond that, another 5, so in total 13. Another 5 of them were seriously unaffordable, which we bank or metric to 43% of wages. So think about half of housing costs, half of your earnings going to housing costs. It's really hard to own a home in the New Jersey area. And we think that the shock from COVID could easily turn most of New Jersey towards higher foreclosure rates, which is just cyclical. Ohan's going to talk about kind of the cascading effect that could have in the market, and again, particularly in Jersey. Continuing with Jersey just for a second, all 14 of those counties in the top 50 have higher than average numbers of underwater homeowners, some way above the national average. So just for some reference, national homeowner underwater rate is somewhere around 12 to 13%. We generally track around 13 right now. And of the counties in Jersey, 6 of them have 25% or more underwater homeowners. So think about a quarter of all homeowners being upside down on their mortgage, just kind of a recipe for foreclosure in the next year or so. Ohan's going to talk a little bit about the delays we're likely going to see and how foreclosures will play out when he talks about some of the regulatory programs there. But truth be told, we don't expect it to be a pretty situation out in New Jersey. I mentioned that New Jersey obviously has a higher foreclosure rate. We see that increasing. Why don't we move on to counties that we think are least at risk for a COVID impact. I mentioned the West earlier as having a kind of a lower regional risk. The Midwest and South, we see the same way, but for slightly different reasons. In fact, a number of counties in the top 20 least risky counties are in the Midwest and the South. The slide lays that out, about 8 in each. And the primary driver there is that housing is more affordable. That's the primary driver. They're the lowest priced, most affordable homes in the U.S. And as a byproduct or a supporting factor, it's also some of the lowest foreclosure rates in the country. So you contrast that with the West, where we said, low foreclosures but really high equity sort of offset the unaffordability issue. In the Midwest and South, it's all 3 factors that we think are going to soften the blow of any housing crisis that could come up there. Next, I want to introduce Ohan Hentebian. He's our general manager for RealtyTrack.com, which is a leading real estate and investor-focused portal that he's going to give an update on where the market is today and where we see it might going for a couple of different segments. Ohan?
Thanks, Todd. First, I want to talk about the prices, home prices. It's been reported in many places, including the study that we put out, that the first quarter we've seen home prices flat or even a slight increase. I want to start by this statement: unexpected big events accelerate trends, but they rarely create new lasting ones. There's been underlying trends that's been going on in the last 2 decades in real estate in our industry. One is number of transactions. In the early 2000s, we've had 7 million annual residential real estate transactions. In 2019, we closed 5.5 million transactions, and that trend has been going on for some time. The second one is home ownership, length of home ownership. Today, we have 10 plus years of home ownership, and in the past, that was as low as 5, just 5 years of length of home ownership. These 2 trends are deeply rooted in our industry, and they do explain some of the acceleration in this trend that the pandemic caused. Now, during the recession that we experienced in late 2000, home prices plummeted, yet we're not seeing that, at least for now, given the pandemic. Again, in my opinion, it's because it just simply those underlying trends accelerated. Now, another reason that can attribute to this is the supply and demand. During the recession, the market got flooded with supply. There were a lot of homes that came to the market, either foreclosure or non-foreclosure. Just there was an increase in supply, while demand stayed very low. Contrast that with today, we are seeing a sharp decline in supply, in some markets as high as 30%, 35% reduction in supply, where, like Todd mentioned, a lot of homeowners are staying on the sidelines and deciding to hold off before they sell their home. But also the buy side is declining. So there's an equilibrium of supply and demand, thus perhaps explaining the flat or slight increase in prices that we've seen so far. Now, while that's about the prices, that doesn't mean foreclosures aren't coming. Again, Todd hinted to this as well in his discussion. There will be foreclosures coming. Now, first, let's look at where we are today in the foreclosure counts. They remain historical lows, the foreclosure counts. Those are fictitious. One, because they're lagging, but there's two other reasons I do want to mention today. One, at the county level, we are experiencing some recording delays, meaning that there are foreclosures, but they're simply not getting published. So they're there, but we're not aware of it. So that's one. And second is the forbearance program that Todd mentioned as well. So that's delaying the surfacing of the foreclosures, right? So once these two factors dissolve, we will witness a significant increase in foreclosures. The foreclosure volume or the breakdown of those foreclosures, however, is going to be different than what it was during the recession in the late 2000s. I forecast that a large portion of those disclosures are going to come from the non-owner occupied properties. In the United States, 35% of residents live in a non-owner occupied, meaning they rent, 35%. Half of those rent from individuals. And there's about 8 million individuals that own anywhere from 1 to 10 properties. So imagine as an individual who owns those 1 to 10 properties where I'm not getting paid the rents because of the effect of COVID unemployment. Now I am in deep trouble. Therefore, I forecast that there's foreclosures in that segment significantly. The other factor why I think is going to be a higher percentage in this segment of housing is the demographics of those who are unemployed today. Businesses that did not survive or not surviving this pandemic employ both younger in age employees as well as younger in career employees who tend to not own a home yet, tend to rent. So given these factors, I think there's a delay in the foreclosure kind of occurrence, but nonetheless, it's going to occur, but it's going to occur in a way that impacts us, impacts the housing industry differently than it did in the past recession, where we're going to see a lot more in that non-owner occupied. Now, let's transition quickly on the effect of the industry. The first molecule of the industry remains the real estate agent. As transactions are declining, we're seeing, I don't forecast seeing a mass exodus, at least at the visible level of agents. The pie definitely will shrink, but the agents pay their dues for the entire year in the first quarter of the year, and they've already paid for the whole year. So at that surface level, we're not going to see that. However, we will see it, we will observe it practically through the businesses that sell products to real estate agents. There's a slew of product SaaS products that exist out there, software as a service, where they rely on a few thousand agents buying their products, and that's how they, it's a main source of revenue. So those businesses, in my opinion, are going to be the front line of feeling the effects of this. And specifically, I would categorize there's two different companies that cater to agents. One with the strategy of high volume of sales at low prices, which is, I call it the infamous $29.99 a month that you charge agents. Those, in my opinion, will be impacted more because they rely on the volume of sales. Whereas there's some products that are offered at a higher cost to very high producing agents. I think those companies are going to thrive because agents who have been good at producing high numbers will continue so even more, as even though the pie is going to shrink, their slice is going to remain, and they're going to continue to thrive. Now, aside from technology providers and SaaS products, obviously there's a lot of orbiting businesses around with revenues tied to agents and their transaction volume. Imagine title insurance, escrow, home warranty, all of those. As transaction goes down, number of agents goes down, they're going to inadvertently, of course, be affected. Last but not least, I do want to mention quickly about government, local and state governments, who will see a huge hit in their revenues from transfer taxes. Every different state has their own transfer tax percentages, and as transactions go down, the amount of taxes they will be able to collect is going to go down at a time where states are struggling in paying unemployment benefits. So with that said, I do want to transition back to Todd so he can give us a quick summary.
Thanks, Ohan. Ohan and I spent a lot of our time thinking about what broad impacts might be from COVID-19. It's obviously really hard to have a multi-year crystal ball right now. You hear a ton about various recovery models, all sorts of letters of the alphabet. So we're not necessarily thinking as much about that as we are the visibility in home sales and prices over the next couple of quarters. So just kind of in summary, when we look at Q1, there really wasn't any impact of sales and or prices. Stay in place orders were enacted fairly late in the quarter, some as late as the last week of March. So very, very limited impact in the data around Q1. Q2, as Ohan mentioned, we're expecting just muted volume, very, very decreased volumes across the U.S. He spoke to the supply and demand, indicators where they've come way down. Frankly, supply meeting demand, the demand decrease. And so as a result, we're not seeing an impact to pricing just yet. In fact, quite the opposite. We're seeing, if not a stabilization, the homes that are transacting generally are tracking above prior sales, which is quite interesting given how little demand there is out there. In summary, we see Q2 really as just a sort of a pause in real estate. Call it a 3, 4, 5 month delay in what typically would have been a really good buying season. We're anticipating Q2 and on the laurels of Q1, all things looked great. All the indicators were looking very positive until this hit. And some of the other churn that we saw or that we thought was going to happen in Q2 around the mortgage market, some of the county services Ohan described, those really didn't play out as badly as we expected. Obviously, they're at a much lower volume, in terms of recordings and purchases, but the county services like building permitting, inspections, recording services, we've seen them recover after an initial heavy decline. So that said, I don't think Q2 is playing out where the data is going to tell us a whole heck of a lot about where the market's going long term. We're looking at Q3 as the telltale quarter, and it's the time frame I'm really looking at for prices for a couple of key reasons, and some that we'll touch on here. Number one is unemployment. You guys see the stats. There's tens of millions of folks getting impacted by this, either through furloughs or layoffs. When we think about the types of jobs that actually drive long-term price issues or distress in a real estate market and prolonged job loss, we believe that's going to be regionalized. Areas that have a high density of companies that can work remotely. The telltale there is say a tech area like San Jose or Austin, San Francisco. We're going to see less impact on the long term from unemployment. Areas that have more of an in-person service-based industry, probably higher. Second factor or second area that I look at and we're keeping an eye on is the home builders. Generally speaking, I look at home builders as some of the most sophisticated sellers of real estate out there, at least relative to your general consumer selling their house. They have a good measurement of supply and demand, and I see it as a leading indicator. So home builders so far are just increasing incentives. They aren't necessarily driving pricing down. Obviously, there's pockets where that's happening. But as a broad brush, builders have yet to lower prices. So if we see that, certainly expect to see that later in the quarter and into Q3. And if that accelerates, I could expect the resale market to follow, just as it would in an up market, where builders are pushing up pricing. So that, again, incentives generally drive future price decreases. If we start seeing that happen more and more, it bodes poorly for the market overall. The third area that we're keeping an eye on is the iBuyer market. For those of you that don't know, iBuyers are companies that buy your home from you through a heavy mix of technology, automation, very complicated analytic or pricing models, and then they'll resell that to the general market as a retail seller. So think of it as buying almost wholesale and then selling retail, but they're creating a demand in the market that has gained traction over the last year and a half, 2 years. There's a lot of research around that. But 2019 we saw as a sort of a coming out party, if you will, for a lot of the iBuyers. And frankly, we expected them to have a much bigger impact than they have so far in 2020. In fact, most of them have largely paused buying. And that just removes demand from the market, just like traditional buyers, consumers, not being able to see houses because of their stay-at-home orders. iBuyers have largely paused their buying. A couple of the big names actually came out this week and are slowly putting their toe back in the water, if you will. But it's very measured, a very measured approach, and most of the other bigger names that operate iBuying type programs are still on the sidelines. So that said, we're generally bullish on the iBuyer model overall. We really like the idea of the way they buy, the way they sell, solving some very specific both seller needs and buyer needs. Really, and especially in this healthcare environment we're going to be in for the next couple of years. But it's really unclear if they're going to come back this year in full force. So again, demand coming down, potentially causing pricing decreases. In short, we're feeling that a housing crisis could happen if COVID-19 stalls the economy for much longer. Haven't yet seen the data that tells us it's here. And as I said, we're right in the middle of a typical peak buying season. And if this continues for several coming months, we may miss that buying season entirely, and Q3 would be very negative or dismal from a sales and pricing standpoint. So that said, keep an eye on the data. We do put out a number of different reports regularly. We put out a lot of press. You guys should look for that. We'll tend to try to keep you as updated as we can and real time as we can on the data that we're seeing and what we're feeling on the ground in the local markets. So with that, I'll turn it back to Jen, who will close us out with Q&A.
Great. Thank you so much, both Todd and Ohan. So again, please make sure to submit any questions in the questions pane, and we'll be sure to answer within 2 business days. Also, you will be getting a copy of this presentation, so don't worry about that. And then also, just thank you so much, everyone, for attending. A few quick resources before you leave us today. Please visit our website at attomdata.com for more information on ATTOM and to keep up to date on the housing market as it pertains to the coronavirus impact. Also, be sure to visit our dedicated COVID-19 housing market insight page to stay up to date on the current climate of the market. We also have a newsroom on our website where you can read articles on market trends, case studies, and more. You can also subscribe to our news and events updates there. And finally, if you're interested in learning more about any of our data and solutions, please either reach out directly to your ATTOM representative, or if you don't know your representative, you can visit the Contact Us page on the ATTOM website and just fill out the form, and one of our data experts will get in touch with you right away. Again, thank you so much for joining us today, and we hope you enjoyed our presentation. Have a good day.